Good afternoon to all of you, and welcome to this year-end financial year 22 presentation for us in Benchmark Holdings. As Hannah was saying, I'm Trond Williksen, I'm the CEO of Benchmark, and as usual, I have with me Septima Maguire, who is our CFO. And we are here to give you insight into our last financial year, covering financials, main events, as well as outlooks for the company. As some of you might have seen this morning, we have issued two important announcements. One is on the results for financial year 22, and one is us now moving on with the listing at Euronext Growth in Oslo. Both of them will be covered in this presentation. But let me start with some highlights from our last financial year 22. We are, of course, happy to announce that we have ended a financial year with good strategic, operational, and financial progress for Benchmark. The last quarter of the financial year was not an exception to what we have shown in the quarters earlier in the year. Q4 was a good quarter for us, ending what we see as being a strong year. The main numbers, they speak for themselves. We have managed to lift our top line by 27% for the year, reflecting strong growth in all our three business areas. Even more important, we have grown our earnings from operations even more for financial year 22 in totality. We have lifted our adjusted EBITDA with 60% compared to last financial year, ending at an EBITDA of 31.2 million for the year. This corresponds to an EBITDA margin of 20% for the group, an increase from 16% in 21. Q4, strong quarter, represented a continuation of the consistent growth and improvement of operational results quarter by quarter, and that we have shown since we finalized the restructuring at the end of financial year 20. This consistency was what we set out to achieve, and this has been what we have delivered on, and this is what we aim to continue to deliver on in the time to come. Even if the financial results from our operations shows very strong development, and we have improved our cash conversion, our operational cash flow, and free cash flow compared to last year, we are still not where we aim to be from a P&L perspective, reflected in an operational loss of 7.9 million for the year. This loss is heavily influenced by the increased depreciation related to the commercial launch of Ectosan Net and CleanTreat, our solution in the health business area, launch that we did last year. In the very first year of the introduction of this solution to the salmon industry, the activities have not been sufficient to cover the burden of 10 years of development now coming through into our P&L as depreciation. This is not a large surprise to us as management, but nevertheless, it's not a situation that we intend to stay in too long. Financial year 22 has been a very busy year on very many fronts, and I'm really proud of the whole organization that has really responded very well and worked incredibly hard to meet our targets. One of the milestones achieved is the successful refinancing of the group with a 750 million green bond. And we have also, after the year-end closing, we have refinanced our RCF. We managed to do this refinancing in a market that everybody knows has turned to the difficult side. Now having this refinancing in place means that the group remains in a very strong financial position, ending the financial year with cash of 36.4 million and available liquidity of 45.8 million. The fact that we managed to qualify for a green bond financing also reflects the strong efforts that we have had over the last 2 years to live our vision of being a company with strong ESG credentials. We have undergone a strong transformation from talking about sustainability to actually living it, systematically working on a range of areas from net zero commitment, sustainable sourcing, animal health and welfare, to real engagements in the societies that we are part of. This is a way of operating. This is a way of thinking that is embedded in the organization, and it will be further strengthened in the years to come. A main topic of the year has been the listing in Oslo, the world's leading aquaculture and seafood listing venue. As we have announced in a separate earnest this morning, we are now moving ahead with this listing, in the first instance with a listing at Euronext Growth. Connected to this listing, we are doing a limited placing and retail offer of shares to fill the listing and free float requirements at Euronext Growth. The placing is limited to 5% of the issued share capital. Books will be open from December 1st to December 6th, and we intend to have our first day of trading at Euronext Growth on or about December the 15th. As previously stated, our intention is to uplist at Oslo Børs within the first half of the coming year, calendar year 23. And the board will also consult with the shareholders on whether to maintain its current AIM listing. Moving on to give more granularity on the performance in the quarter in our three business areas, starting out with genetics, where we have had a very strong year, a year where we really have seen growth from invested infrastructure come through. For the financial year in totality, we have seen growth of revenues of 24%, up to 58 million. At the same time, we have seen earnings from operations or adjusted EBITDA grow by 76% compared to last financial year, to 14.4 million, excluding fair value uplift. The driver behind the strong growth in revenues and earnings is the strong development within salmon genetics, where we have seen record high sales of salmon eggs out of Norway and Iceland, and especially Iceland has had a particularly strong development. On the back of the investment that we did in a new incubation center there, we have been able to take advantage of the strong demand for our salmon eggs, giving us better utilization of the new facility than we actually expected. The new incubation center has really been a good and timely investment for us, both from a quality but also from a volume perspective, and that we have utilized. Given the experienced undersupply of local salmon eggs in Norway, close to 50 million eggs were sold from that facility on Iceland to supply the Norwegian market in the financial year. Our Chilean salmon egg business has had its first year of operation. The operation is going well, but the number of eggs sold are still at the low end, as we would have expected. Our effort to penetrate this market in a responsible way continues, and it's now helped by us also having the organic certification in place. Like our salmon eggs business in Chile, our Aspia shrimp genetics program and our genetics program on tilapia remains growth vectors for us in the future. In our shrimp genetics program, we have seen good commercial progress over the year, exceeding our sales targets for the first full year in commercial operation. We continue our efforts here to tailor the genetics to the different conditions in the different markets, being on a journey where we aim for a significant position in the market, total market over time. Both for our shrimp genetics program and our tilapia genetics program, we have completed the investment in needed infrastructure for the next phase in the commercial development and growth. Key for us as a leading genetics company in aquaculture is to make sure that we are in front in terms of science. This is also why we are focusing on strengthening the genetics scientific team with new world-leading resources. The recruitment of Dr. Ross Houston to lead our genetics R&D activity is part of this, and further high-caliber resources is now being added to complete our scientific team in this area in the time to come. Moving over to our largest business area, advanced nutrition, where we have seen a continuation of a very strong commercial performance throughout the year. Our top line growth within this area ended at 14% for the full year, while our adjusted EBITDA grew by 38% to 19 million. I would also like to remind everybody that in this business area, we have been able to triple our adjusted EBITDA over the last 2 years. A dominant part of the progress that we have experienced is, in our view, a consequence of enhanced operations and sharpened commercial effort by our excellent team in INVE. And yes, we have been helped by improved market conditions in the shrimp market since the early days of COVID, but the growth we have experienced also this year outperforms the underlying growth rate that we have seen in the market in general. All in all, our advanced nutrition business has ended a financial year with growth in all their 3 product categories. We are also especially happy with the rebound and growth that we've seen in Ecuador, which is a key production region for shrimp. But we have also seen good developments and progress in other markets, not only in the shrimp industry, but also in the marine finfish industry. Key to us over the last 2 years has been to optimize our operation and strengthening our commercial efforts and team. We have also been working on streamlining our R&D activities. The efforts we have done on these areas have given good results and will be, of course, a strategic priority also for us in the time to come, as will our efforts to launch new technologies, as well as developing our activities to become more sustainable in our operations. Finally, on to the last business area, our health business, where we saw good progress in adoption of the Ectosan wet and clean feed solution in the last quarter of the year. Coming out of June, July, with very low utilization for our 2 vessels that we have deployed, the picture has really changed considerably entering into what is the main sea lice season in Norway that starts at the beginning of August. Since then, the uptake of the solution has been good. One of the 2 vessels we have deployed is on a charter with our main salmon producers, while the other vessel is utilized in the spot market doing treatments for an increasing number of salmon farmers in the Norwegian market. Given that we had very low utilization of the vessels in July, the financials for Q4 does not reflect the increase in adoption that we have experienced from the early fall onwards. The financials for the financial year is also in total also mirror that we have been through a first year of operation after the introduction of the solution. Even if we obviously are not satisfied with the financial performance in our health business area for the full financial year, we are very conscious that we have used the year well on work on investment necessary to increase the efficiency and adoption of the solution. We are also satisfied that we have gotten confirmation that we have a unique solution that is on its way to become an important tool for the industry in solving the sea lice issue, as all the fundamentals of the solution that we told the industry when we started has been confirmed. As stated, when we did our Q2 and Q3 presentations, we are on a journey towards making the solution less costly, more adaptable, less capital intensive in the future. Key is integration of the clean feed technology in the infrastructure of the farmers, taking down cost, risk and capex, both for us, but also for the farmers. This work is ongoing every day and will do so also in the time to come, in close dialogue with the farmers, but also with partners that could play a role in ensuring we enable to take out the potential of the solution in the future. Finally, a few words on the development of the group as a whole. Financial year 22 has been a year of significant strategic and operational progress, and another year with very strong commercial focus to drive the financial progress in all the 3 business areas. This is what you have seen from us so far, and this is what you should expect to see from us also in the time to come. Will the commercial progress gain be a straight line development? Probably not, but we are very determined on the direction of travel for the group. Taking out synergies from being one group, one benchmark, has very much been on our mind over the last financial year. Tangible changes that has been made over the last year is alignment of resources across the group on commercial, marketing, sustainability, R&D, and people. This is key to take out operational efficiencies in the group, and something we will do even more of in the time to come. We also continue our work to drive cultural change, as well as driving performance through a very well-defined performance framework based on clear strategic priorities. This has shown very efficient for us in order to drive performance. And finally, our work to deliver on our commitment on sustainability and ESG has been and will be a strong priority for us. In financial year 22, we have made good progress towards our net zero commitments, as well as a number of other areas crucial to improve our standing as an ESG company. It's needless to say that this will still be a key focus for us in the year and years ahead. With those comments, I will now leave it up to Septima to take us through the financials in more granularity. So over to you, Septima.
Thank you, Trond. So financial year 22 has been a year where we've made significant progress. We now have 3 business areas where we're fully commercially launched, and this shows through in the numbers, with strong revenue growth driving improved adjusted EBITDA up 60% to 31.2 million. And from a quality of earnings perspective, adjusted EBITDA excluding the non-cash fair value uplift rose 83% to 29.6 million in the year. As Trond noted, our operating profit was impacted by higher depreciation and amortization charges associated with the rollout of Ectosan Vet and Clean Treat. Additionally, during the year, we also refinanced our NOK bond, and this resulted in significant non-cash movement on the hedges and a write-off of the deferred financing costs associated with the old bond. In addition, we incurred a one-off penalty for the early termination of the old bond of £1.6 million. But we're really pleased to have this refinancing in place as we look towards the future. So moving on to the next slide, where we can look at revenue. We've had a year with a continuation of the consistent delivery theme that we've seen in the business since the restructuring. We've continued revenue growth in all business areas. We've made steady progress in all business areas with growth in nutrition and genetics, driven by the well-established core businesses. And with the newly launched Ectosan Vet and Clean Treat, health has also seen good growth in the year. This has driven growth from financial year 20, which was the year of the restructuring, to financial year 22 at a rate of 50% for the 2 financial years combined. We see this as a very strong step in the right direction. Moving on to the next slide, where we look at EBITDA. So the growth in sales has driven strong growth in our gross profit. And with good cost control, this has resulted in growth in adjusted EBITDA at an absolute level, but also we've delivered strong progress on growing our adjusted EBITDA margin, moving from the 14% in 2020 to end this year at 20%. We've delivered a strong set of results in each business area. Nutrition came out with strong commercials and cost focus. Genetics delivered excellent growth in the core businesses in Norway and Iceland, which continued to fund the growth areas. And health, moving from a loss of 2.7 million last year to a positive contribution of 0.1 million. In addition, from a quality of earnings perspective, net exceptionals were nil during the period, with the income from previous disposals offsetting costs associated with the Oslo listing. Moving to the next slide. So halfway through the year, we communicated our medium and long-term financial objectives to aid investors' understanding as to how we were moving the business forwards. As you can see, we've progressed towards our financial objectives in financial year 22, delivering strong revenue growth of 27%, which has driven good margin expansion, bringing our adjusted EBITDA margin of 20% towards the target margin of 25 to 30%. And with stronger cash conversion of 35%, we've been able to move the free cash flow in the right direction towards our target free cash flow. And how does that translate into our business areas. So moving to the next slide. With strong objectives of revenue growth, good cost control and cash control, taking the business towards profitability and cash generation. In genetics, the levers for growth are of course expanded into the invested capacity of Norway and Iceland and penetrating the market in Chile for our salmon eggs. In addition, growth will be supported by the newly launched shrimp and incrementally by our tilapia sales. Nutrition, we expect to grow ahead of the market, which has been supported by our results within financial year 22. And in health, as we gain traction in the market for Ectosan Vet and Clean Treat, we're getting better profitability and cash generation from this business area. So moving on to focus on to genetics. So genetics had an excellent year with revenue growth at 21%, solid gross margin and good cost control, taking the adjusted EBITDA margin to 28% on an adjusted EBITDA of £16 million. Even excluding fair value, adjusted EBITDA was £14.4 million in the year, a growth of 76%. This result was linked to our ability to meet the increased market demand for salmon eggs, which we were able to supply from the newly invested incubation house in Iceland. Whilst the new incubation house only officially opened in August 22, we were able to start ramping up capacity and utilising it before that. And this resulted in the total number of eggs sold increasing by 24% to 291 million in the year. In other salmon revenue streams, harvest revenues were higher, benefiting from the high salmon prices during the year. And newly launched salmon Chile has moved to the commercial phase, and we continue to focus our efforts on penetrating that market. On shrimp, we commercially launched during the first quarter of this calendar year, and we continue our efforts to grow that market. As we've now commercially launched, we've ceased capitalising costs, and now all costs are flowing into adjusted EBITDA. In terms of tilapia, the tilapia expansion was delayed due to COVID issues, and therefore we did not complete it to have it in place for the full year, albeit we should see the effect of it come through in financial year 23. Moving on to the next slide, where we focus on our genetics growth areas. So, as I mentioned, genetics had an excellent year, with the core salmon business of Norway and Iceland delivering over £22 million of adjusted EBITDA. This momentum allows us to support our newly launched businesses, which aren't yet profitable but represent opportunities for future growth. In total, we invested a combined adjusted EBITDA loss of £6.5 million in these areas, driven by the full year of commercial costs for Chile and a half year for shrimp. Tilapia's expansion, as I noted, was delayed, so we weren't able to achieve the full year's production during this financial year. In terms of CapEx for these areas, now that we've closed out the large CapEx for these growth areas, the focus is on driving profitability and cash generation in these areas. So moving on to look at nutrition. Nutrition is an important part of our business from profitability and cash generation perspective. And nutrition continued to deliver good progress during the year, with revenue growth in all product areas, showing the continuation of sharpened commercial focus. This growth was supported by strong currency tailwinds, as the US dollar was strong throughout the year. But increased revenue also drove better manufacturing volumes and resulted in gross margin increasing from 51% to 53% in the year overall. This, coupled with excellent cost control, even as we invested into the commercial apparatus, drove adjusted EBITDA growth to 19 million and adjusted EBITDA margin to 24%. A very strong result. Moving on to health. So health has made significant progress in the year with the first full year of Ectosan Vet and Clean Treat. During the year, with one vessel with a Clean Treat unit aboard operational for the full year, and the second unit came online in December 21. Combined, they delivered revenue of £14.8 million, of which £2.5 million related to revenue for vessel-related costs. The gross profit increased by £4.6 million to £8.3 million, which offset an increase in operating costs of 1.9, and ultimately moved the business area from being loss-making in financial year 21 with an adjusted EBITDA loss of 2.7 to an adjusted EBITDA profit of 0.1, albeit marginal. But we still have progress to make in this business area to move it towards its target margin. But with a full year's operations completed, focus will be on improving profitability and cash generation for this business area. Moving on to the next slide. So operation costs grew at an absolute level, but reduced as a percentage of sales. Growth at an absolute level was driven by increased activity in the core business and costs associated with the newly launched commercial areas such as health, SBR shrimp and Chile. Whilst OPEX increased, R&D decreased in the period as we ceased capitalising costs associated with the development projects. Our main focus in ongoing R&D now surrounds the breeding nucleus in genetics and our ongoing development projects in our nutrition business area. Moving on. So as you can see, as part of the restructuring, we invested significantly in the business, in both the core established businesses to get them caught up from an investment perspective, and then invested in the development areas to allow them to commercially launch. We're now sitting with 3 areas which have all of their development projects fully launched. With this new commercial phase, we can expect that our operation cash flow, which became positive in financial year 21, will continue to grow, and the quality of earnings will support this. This, of course, will then, with more moderate capex as we move forwards, allow us to grow our overall cash flow generation and become cash flow positive. So moving on to look at working capital, a key part of our operations. This is an area of significant focus for us as we move forwards. As you can see, working capital grew at an absolute level, but remained stable as a percentage of sales. We want to focus on this, taking it down in the coming year and thereafter as we grow the business to ultimately unwind some of the working capital. In health, the working capital increased through, of course, the ramp up of Ectosan Clean Treat, but also as we moved the 3rd Clean Treat unit into inventory, given the intention to move to a new operating model where we sell the unit directly to the customer for use within their infrastructure. Genetics inventory increased due to increased biological assets. We've got more fish and also more eggs due to ramping up our facilities in Norway and Iceland. And in nutrition, with increased inventory of Artemia, but also higher overall inventories due to increased safety stocks in place to combat logistical challenges. So moving on to look at net financial expenses. As you can see, there's a number of moving parts within the finance costs, but there are 2 main items to note. The closeout of the old bond resulted in the early settlement penalty and the increase in amortization as we wrote off the remaining deferred financing costs associated with the old bond. Additionally, you can see the significant swing of 9.4 million, the non-cash movement on the cash flow hedges, as the old hedges were closed out and newer hedges were put in place. In terms of the interest on bond debt, we expect that this will remain at the current levels in the next financial year, based on the financing costs of the new NOK bond. The interest on finance leases increased in the year due to the leases associated with the PSVs as part of the Clean Treat operation. Moving on to look at our cash flow and our net debt position. So as you can see, with improved trading came better cash generation, with cash from operations after working capital of 18.3. Within the capex figure of 12.7, we had the capex to complete the incubation house and also the cost of a 3rd Clean Treat unit. As we've previously noted, Clean Treat moving to a customer infrastructure and lower overall capex within the rest of the business, we expect the capex burden to be more moderate going forward, which is an important tool in moving us to positive cash flow. Trond and I have both noted our desire to move the business towards positive cash flow, and we have a number of levers we can use to support this. Better trading, of course. Strong trading supported by good cost control is very important. Unwinding some of the working capital, as we've noted before, and of course, moderating the capex burden. With our core businesses having been invested in over the last number of years, now's the time to get better asset utilization out of the business and moderate the capex. And this will allow us to push forward towards cash flow positive in the coming year. Moving to the next slide. We've made significant progress this year, but not just in moving the business in the right direction, but also with respect to ensuring that we've got the right foundations for the future. And of course, an important part of this is our financing. During the year, we refinanced our old secured 850 million NOK bond, replaced it with an unsecured green 750 million NOK bond with a maturity of September 25. In addition, we also refinanced our debt associated with Salton, consolidating our facilities and extending the term out by 5 years. And finally, we refinanced a $15 million RCF and replaced it with a £20 million RCF with a maturity of June 2025. Having these facilities in place allows us the flexibility to focus on the business and cash generation, knowing that we're well financed as we move towards the future. Back to you, Trond.
Thank you, Septima, and on to the outlooks. After ending our financial year with very good and strong progress, we are of course very happy to be able to state that we have also had a good start of the new financial year. Where we are right now, we see good momentum in all of our three business areas when we are now started on our new financial year 23. I think it's obvious to everyone that we are living in a more unsure world at the moment, with numerous issues that could impact any business, not only ours. Our focus, given these surroundings, is to do whatever we can to optimize the performance in our business, and not allowing ourselves to be too distracted by uncertainties outside our control. I would also like to remind you that we are a very well diversified business. We are a very well positioned business. And what we deliver is mission critical solutions, solutions that is needed anyway for our farmers around in the global aquaculture industry. If you couple that with a proactive commercial approach, strong commercial focus, this creates resilience and mitigate potential impact from ongoing cost inflation and macroeconomic pressures. One of the topics that I know has been discussed is also the recently proposed change in tax regime for the salmon producers in Norway. This is a proposal that has been given by the government. It's on a hearing now. It's going to be implemented throughout the next year. The way we see it, we expect that this new proposal will have just a marginal direct effect on our business. To the extent that we will see implication, it will be related to the growth rate of the salmon production in Norway in the years to come. Some fear that it will take down the growth rate. Again, the tax proposal that is proposed is designed in a way, and it's stated to be in a way that it's not supposed to take down the growth of the industry. It's to take a fair share of the high profitability in the salmon farming core activity and share that with the society. Given this morning's announcement, also mentioned in the beginning of the presentation, it should be needless to say that we continue to progress towards a listing at Euronext Growth in Oslo. We strongly believe this will be beneficial for the company and its shareholders, really placing the company in the center of the strong world-leading aquaculture cluster that is surrounding Oslo Børs. On a final note, let me end our presentation reminding you why Benchmark is such a unique company, such a unique value proposition, and such a unique investment opportunity. Next slide. We are in the aquaculture industry, and we are very happy to be in this industry. It's a young industry, it's a prosperous industry, it's a growing industry supported by global megatrends. It's an industry that will play an important role in feeding the world in the time to come. This is an industry that will give structural growth for those companies who are well positioned in the space. And this is all about what Benchmark is. We are very well positioned, holding market leading positions in all the three business areas in everything we are doing, and holding market leading positions within the leading species within aquaculture. In sum, what we are is a unique, mature biotech platform, well invested, well prepped for growth, well prepped to develop in the years to come. We've been through the development stages. We now have a strategy and a financial framework that should drive growth and returns to the investors. And finally, we are more than just an ordinary company. We are really a purpose-driven company, strong organization, strong ESG credentials, that makes it, that creates another dimension on top of our commercial focus. So with those words, Hannah, I leave it up to you to take us through some questions, I assume.
Thank you. Well, I think you've touched on this already just there in your closing comments, but is there anything you want to add on the impact of the business from the proposed salmon tax increases? And I guess, have you run any sensitive analysis that you can share with us?
Yeah, I can just comment a little bit more on it, because it's a question that it's really raised a lot of times. We think that we are sure that the direct implications of the tax proposal, if it's going through as it is proposed, will be limited. We see that there is a production tax as part of this that is currently at 0.4 NOK, that is proposed to go up to 1.2 NOK. That will hit the small portion of our incomes that comes from slaughtered fish within genetics. So it's a marginal. That's the only direct implication we see. We don't see any changes in behavior or demand for salmon eggs. We don't see any changes in behavior and demand for ectosan and clean treat, which are the main products there. And the key to understand our position in this is that unlike other companies, we are a company that only provides mission critical solutions, and products. They need to have eggs. They need to have salmon sea lice treatments. Sea lice treatments is not taxed, so they need to buy it anyway, and that's reflected also in the demand pattern that we see. Total income from the group from Norway is 32%, so we see that we are well diversified. Yes, it could have an impact on the growth of the Norwegian salmon industry, but again, this model of taxation is taken from the Norwegian oil industry, and it's supposed to be investment neutral. It's supposed to be growth neutral for the industry. So see how it lands. But I think, unlike other companies providing, for instance, capex goods into the industry, we are very well positioned. That was a long answer.
Yeah, it was a thorough answer. Thank you. On to clean treat. Where did the idea to morph from the investment in ships to doing it perhaps outsourcing? The epiphany obviously came after the investment in a couple of boats. So, what changed?
It's a good question. It's a really relevant question also, but you also, when you're starting things, you always have to have a starting point. And our starting point, in order to get the solution launched at all, was that we needed to provide the medicine. We needed to provide a platform for the clean treat, because that's one solution. You cannot use the medicine if you don't have the clean treat system. It's not allowed, and we will never allow it. So we needed to have a platform for a clean treat system. At the time, there were at the launch, there were no big wellboats that we could place it on. There were no other platforms that we could place it on. So we ended up placing it on a PSV. And in order to get started, we just needed to do the investment in installing them on time-chartered PSV, 2 time-chartered PSVs. It has been obvious to us all the way that that's a costly entourage around the solution. But as again, we need to start somewhere, and we started there. So since then, we have been focusing on, of course, getting as much traction as we can out of the current setup. But we have always been conscious that this needs to be moved to a situation where it becomes leaner, less capital expensive, more adaptable for the customers, and less risky for us. So that's a journey that we have taken since we started.
Well, perhaps moving on then, obviously the investment that you have made to date is sitting there on the books. Is there an opportunity then, as you move on to this new model, that you can sell those boats either to customers or another? I mean, there was a big focus there in the presentation, Septima, on working capital. This perhaps might be one of the levers that you will pull.
Yeah, and the short answer on that is yes. And that this is what we are aiming for. You know, we don't need to own the clean tree system. We can sell it with the right to use. We would like others, farmers or other service providers, to hold the business model around the clean treat going forward, because our business model is to be a provider of very efficacious medicines.
Okay. I think you sort of covered this in your previous answer, but perhaps just a little more comfort. Is it correct that existing salmon farmers can dump their wastewater into the sea and thus do not need to buy clean treat? Is there legislation that forces them?
No, when it comes to when it comes to access on that, it's only allowed. It's only allowed, and we will never allow anything else than it needs to go through a clean treat system to clean out the medicine and release clean sea back to the seabed. I've been a salmon farmer myself. I know the history of it. You know, I strongly believe that this is the future of using medicines in aquaculture, and we are the front runner of that. That's why we're driving sustainability in aquaculture.
Okay, and then just back to clean treat briefly. The third vessel, obviously you mentioned this, Septima, in your part of the presentation. It's available to be used. So what is the plan there specifically?
So I made reference to the fact that we had moved the third clean treat unit into inventory, because the intention is to sell that directly to a customer and ultimately put it on a bespoke platform, be it a wellboat, be it a barge, and to allow them to have their own clean treat system in place within their own platforms, within their infrastructure. What that does is it reduces the capital intensive nature for us, because it takes out the need for the PSV, but it also removes the capital intensive nature for the customer, because they don't have to pay the additional cost for the PSV. So it's a very balanced approach to sharing value in terms of the new business model. We all benefit out of this sort of more evolved approach in terms of that. So that clean treat unit has been coming into the inventory and to the docks effectively over the last number of months, and the last parts of it will be coming in over the next quarter or so.
Thank you. What's the plan for clean treat and Ectosan in terms of new territories and market approval?
Norway is more than 50% of the global salmon production market. So we've always been very clear that, you know, we need to make a success there, and that's the starting point. We know that we and have announced that we got the marketing authorization of Faroe Island. That's very close by. It's a farming region. Then we have Iceland, then we have Scotland, then we have Canada, then we have Chile. You know, and probably in that order, you know, we will look at opportunities going forward. You know, but you know, we are very focused on not running ahead of ourselves in benchmark. Now we are ticking off boxes. That's what we are doing. So we are very focused on ticking off the boxes, getting the learnings, getting the traction, getting the earnings out on the Norwegian market. And then we are, of course, ready to move into the other territories to really take out the potential of the solution globally.
Thank you. Well, that's it for questions from the floor. So thank you to you both for the time you committed, and thanks to the rest of you for attending. And we'll look forward to an update in end of Feb.
Wonderful.
Lovely.
Thank you, Hannah.
Thank you all.